Friday, July 14th, Bastille Day. Our president is safely in France and left us here. Trying in some desperation to stay out of politics. It's there, but markets this week just dead flat. There's no real change in interest rates. There was a jump in the stock market within 15 minutes of Janet Yellen's testimony to Congress on Wednesday, which gave everybody the impression that the Fed will be less aggressive than we had thought. And the data pattern says that the Fed should be less aggressive. The inflation is, whether temporarily or longer term, not rising to the Fed's 2% target, which takes some of the urgency out of the Fed. The deeper questions are, what's up with inflation, or what's down? Why is it this way? The jackdaws in the financial markets and news media, who have a wonderful time pulling the feathers off the Fed, at the same time that they will say that the Fed has been too easy, think that it's not tight enough now, and they switch back and forth whenever they feel like it. And most of that commentary is corrupt, all except mine, of course. But there isn't any failure at the Fed in having estimated higher inflation than we've gotten. That's a hell of a lot better policy stance than to have estimated lower inflation than we've gotten and been behind. Yellen's been in office for almost 4 years. The bookies think that her chance of reappointment is all of a sudden very low, and that's a flip from a month before when it was very high, and so forget about it, nobody knows. But the Fed stance has been ideal. It has begun to raise the overnight cost of money just in case, but it couldn't be more gentle about the process. One form of Fed tightening is to raise the cost, the overnight cost of money, known as the Fed funds rate. Another aspect of Fed tightening is to actually tighten lending conditions. So money gets a little scarcer, not just more expensive. And the Fed has come up off zero in the overnight cost of money. It's now at 1.25. It will probably add another quarter before the year is over. But there isn't any tightening in credit conditions anywhere in the economy, nor is there any part of it that's too loose. There's fear that rates so low are creating bubbles in the economy, and they may. But bubbles aren't dangerous unless there's leverage, unless they're inflated with loans. When you unwind a levered bubble, you take the banking system with the bubble. We don't have that. We don't have it in stocks. We don't have it anywhere. We don't have it in real estate, commercial real estate, commodities, nowhere. There's undoubtedly some excess leverage in the world, but to the degree that it's out there, it's very likely to be overseas and not here. In the copy next to this video, I've given hyperlinks to a speech by Robert Kaplan, who's the new president of the Dallas Federal Reserve Bank. And this is a smart guy. This is a very interesting guy. And he spoke to the cause of unusually low inflation. And he thinks especially important is the technology impact on what's called pricing power. That is the ability of business to raise prices. And he sees pricing power as the weakest in his lifetime. And it may be weaker than that. And also posted is a blog by Bernanke, whom I miss. And Bernanke, in a piece titled When Growth is Not Enough. And he takes us from the bipartisan, Main Street level upset with the economy, that the economy is not good enough, and leads us by the hand through how that could be so. We're in a recovery. We've been in a recovery now for 9 years. The economy's growing at 2% a year. Wages are growing some. The unemployment rate is dead low. And yet the whole country at the Main Street level, except maybe in Palo Alto, is unhappy with the economy. And he takes that one apart as to why that is so. And he delivers a quiet prescription towards the end of his piece about what could be done and what should be done. And the bottom line in it is tough. Despite what you hear from both parties, Regulation's not really the issue. Taxes are not really the issue. Not a tax cut or a tax increase. Nor is tax reform, if all that tax reform is going to do is tilt the table one way or the other. None of that stuff matters. It's not the important stuff. The important stuff, according to Bernanke, is that in the great change in America after World War II, when the world was our oyster, when America, in Bernanke's term, had a global monopoly. Beginning in about 1970, we began to lose the monopoly and had to play the game with everybody else. And in the course of those changes, and that's now almost 50 years back, Bernanke says that we didn't pay enough attention to our fellow man. The aid that we could have begun to give dislocated workers, workers with obsolete skills, workers with the least education, workers left behind by out-migration. Think of Detroit. Those classes of Americans whom we could have helped, we did not. And it's the highest order task ahead of us, and the productive one. And most of the noise for both political parties is backward looking, it's not forward looking. I encourage reading it. The Bernanke piece especially, it's in English, there's no math, there are no graphs, it's written the way an enlightened history professor might have written about the period of since World War II. And it will give you faith. It will give you hope that we have all kinds of options. We have only to find the wisdom to use them. Good weekend.